Let's get more market reaction after that Fed decision. David Zervos joins us, as he does on Fed days, chief market strategist at Jefferies. So it wasn't the beatdown that the market got, say, in Jackson Hole or in even the last Fed meeting, but there was a message from Powell that there's more work to do on inflation. What's your take?
Well, Sarah, I think the take is that we're coming down in these rate moves. We've gone from 75 to 50. We're nearing the end. There's another 75 left, according to the SEP. And it's very hard for Jay to remain at peak hawkishness, which is really where he's been for most of the year, when you're kind of bringing you're taking your foot off that brake a little bit. So it was very hard for me to see why people would think you could get more hawkish messaging than usual from Jay into a meeting like this, and I think that's really the story. It's a message that is still very consistent with everything he said all year. That they're vigilant. They're not going to make the mistake of the 70s. He referenced that again. You talked about it earlier in your program. So he's not giving you anything dovish to bite on. But, we were already, I think, very close to peak hawkishness. So it just didn't make sense to go in short. And I think the market's kind of telling you that.
So the market's telling you that bonds are getting bought right now. Yields are lower and the 10-year is below 3.5. So we are well off the highs that we were seeing a few months ago. Do you think that's it? Have we seen the highs?
The market is pricing in a lot of credibility for the Fed. A lot of people like to talk about this inversion as the recession indicator, and it is. There's an indicator that we have a risk of recession, and it's a material risk. It's not guaranteed by any means. And some people think we already had one last year with 2 consecutive quarters of negative real growth and didn't feel that bad. But nevertheless, I think the yield curve and the 10-year in particular is really telling you, Sarah, that just the market has an incredible amount of faith in the credibility of the Fed right now, and its desire to anchor long-run inflation expectations, which they've done pretty well in the face of 2 back-to-back 7-handle years on inflation.
So what do you do as an investor now? We've been waiting for progress on inflation. We got that 2 months in a row. Yesterday, it looked like we were going to get a giant rally, and then it basically evaporated, which suggests that there's a lot of hope and optimism already built in around moderating inflation numbers. So what do you do? Are we targeting jobs reports? What sort of signals do you have to wait for to know whether it's a good time to buy?
I mean, honestly, Sarah, I think next year there's just a lot more interesting opportunities, at least from my perspective, in the credit markets than the equity markets. The big difference between this year and last year is not the inflation rate. The inflation rate's exactly the same as it was a year ago. And in fact, the unemployment rate's only 0.2 away from where it was in the beginning of this year at 3.9 down to 3.7. The big difference is that yields are a bunch higher, particularly in the belly of the curve, and spreads are a lot wider. So to me, you've got an opportunity in some of the more beaten up areas of the credit market or leveraging in the higher end of the credit markets that can give you equity-like returns, even double-digit yield returns, without having to take equity risk. And I think that's going to be the interesting trade next year. I'm not sure that the Fed is going to want to see big rallies in the equity market, and they're going to kind of Jackson Hole you every time we rally up because they can, and they want to get that inflation number down faster. They want their report card to look better, and right now their report card in the last 2 years has a couple of Fs on it.
And especially now, and there's a little bit of a gap in where the Fed thinks the peak rate is going to be in the market. We've got to leave it there. Out of time. David Zervos, thank you for your initial take from Jefferies.